All right. Good afternoon and good morning to everyone, and welcome to our webinar, Financing for Seniors Housing and Care in 2023 and Beyond. Just wanted to start off by saying that our second panelist, Christopher Hahn of New Point, will be joining us as soon as he can. He is currently in his basement in the middle of a tornado warning. So seems like a pretty legitimate excuse. What do you think, Jack?
I would agree, Ben.
So he should be joining us, I guess, whenever the whenever the weather allows him. Which it could be 5 minutes, could be 10 minutes, but we're happy to start the conversation now, and he'll be sure to get us his insights a little later in the call. Just wanted to start with a few details before we begin, though. If you experience any technical difficulties with today's webinar, please reach out to Irving Levin's customer service at 203-846-6800, or you can email us at info@levinassociates.com. And at the conclusion of today's call, a survey will pop up, and your answers help us improve our future broadcasts and also can help inform our future topics. So your participation in that is greatly appreciated, and we'd love to hear what you think. Lastly, a recording of the webinar will be posted on our Levin Pro LTC platform tomorrow, so you can watch and watch again to your heart's content there. And if you have any questions about how to access the platform, the Levin Associates sales team would be more than happy to help. We have to say that when we came up with this topic late last year, we did not anticipate totally the situation that we are currently in, just in terms of the lending environment. Some would say the situation that we are mired in right now. Interest rates have shot up at a quicker pace than ever. A couple of large banks collapsed. The seniors housing and care industry has already seen some major defaults, more could be coming, and the debt market has certainly become less liquid in recent months. So with all these issues currently swirling, that makes the timing of this discussion perfect. So there's that silver lining. And the quality of our panelists, I have to say, will make it even better. But before I introduce Jack, and also I'll introduce Chris, I just want to thank our sponsor for today's webinar, New Point Real Estate Capital. New Point is a leading lender offering HUD, FHA, agency, and proprietary solutions to owners and operators of seniors housing and healthcare properties nationwide. And with that, I'd like to introduce our first panelist, who is not here right now, but that's Chris Hahn of New Point Real Estate Capital, where he is responsible for expanding the firm's seniors housing and healthcare portfolio, focusing on agency loan solutions. He has more than 35 years of experience and previously worked at Regions Bank and at Fannie Mae. So glad to have Chris on whenever he is able to join us. And then we have Jack Bowdler, who is an originator and senior banker at Regions Bank Healthcare and Seniors Housing Group, where he has spent the last 7 years and also had the pleasure of working with Chris. So Jack has approximately 35 years of experience as well, and previously worked at BB&T and KeyBank. Welcome, Jack.
Thanks very much, Ben. It's good to be here. And thanks, everybody, for your attention this afternoon. I hope we can make this a lively conversation, and hopefully we can all get some insights out of it. So thanks so much, Ben, for inviting me, and thanks to Chris also. He was instrumental in getting me to participate. So glad to be here.
Very happy to have you on, and happy to have Chris join later. If you bring up a point, we'll be taking audience questions throughout the call, so feel free to enter your questions in the Q&A box at the bottom, and we'll do our best to address them within the hour. I just want to touch on the outline for today's conversation. We'll set the scene for the state of the capital markets. Then we'll focus on the banks, as there's been a lot of upheaval in that world in recent months. Then next, we'll talk about the agencies and the market for permanent refinances. And finally, we'll tackle some of the kind of larger, bigger questions facing lenders and investors today as it pertains to debt and equity. But I just want to start with you, Jack, and kind of set the scene right now as far as the capital markets, and then your outlook on everything that's been going on just for the rest of 2023 and into 2024. What are we in for?
Well, that's the question I wish we all had the answer to. In terms of the capital markets, I think everyone's proceeding with caution both short-term and long-term in terms of the lenders, and everything's, down to the detail on a deal-by-deal basis. Although, let me start with the broader picture first. What's our outlook for 23 and 24? I think, and this optimism, I think, is for the longer term, and I think it might have been present at the recent NIC conference many attended, but I think there's a little bit of uncertainty in the near term meaning, hopefully it starts to clear by the summer after the second quarter, possibly later into the third quarter. But I really think that things should begin to clarify a little bit as we get into 2024, because performance will lag a little bit in terms of, managing and monitoring covenants and seeing results as the banks formalize their maintenance and portfolio management. So that might cause us to push into 2024 in terms of really seeing a breaking of the ice a little bit in terms of the lending capital on the bank balance sheet side. Anecdotally, I would say, and this is where I'd like to defer to Chris too, but on the capital markets side, we've heard stories, or we've talked to people and seen some intermittent capital markets transactions for Fannie Mae or Freddie Mac, but it's, as I say, case by case, and with folks that are, I would say, very experienced in the industry, have a lengthy track record of over 25 years, and they're well-known repeat borrowers, both to the agencies and probably many on this call. But there's no shortage of challenges, as have been chronicled in your articles and on various other web publications or industry publications.
And just speaking of those challenges, do you just want to highlight a couple that you think have been probably most impactful on the lending environment, like whether lenders are willing to put their capital out there, and also what's been affecting investors the most?
Well, yeah, let me start out with lending, and this will probably be similar to what many of the other lenders in the audience are going to observe as well. But we've focused inwardly, in my experience here inside Regions, we're looking, closely at all of our client relationships, trying to make sure we have them covered and really, have time and resources as they seek to move through this time of a little bit of uncertainty and certainly the higher cost. But really, we felt like we had kind of made it through the tough part of the storm after COVID. The idea of a recovery seemed to be a little more reasonable before rates began to accelerate, and we saw the effects of inflation on staff and the need for agency employees, and all of those challenges have been digested for the most part, but the costs remain high. Labor has been adjusted, and I think a lot of folks have made progress removing agency labor supply from their communities, although the cost of interest has gone up dramatically, and other items in their income statement have become more costly, be it food and or utilities, insurance, things like that. But I think really the issue is the shrinking NOI and somewhat of a delay or lag that could be attributed to any one of a number of items to the consumer base across communities, and each community is different in each market. But I think there are other factors that are impacting the consumers, in addition to all the issues the operators face. But so I think they're focused on keeping their businesses on target and on track, because they've probably experienced a delay in the timing based on supply chain issues, or a delay in lease up, which is going to impact their returns and ability to make their current debt payments. So there are many factors in the mix, and that's probably just the top of the stack I touched on. But
yeah, and the one that you mentioned last is certainly an issue facing a lot of property owners right now. And it's probably why a number of people signed up for this webinar in the first place, is to
I wish I had
find out some
secret sauce
answers.
for everybody here, but I'm
Well, it'll come
we're
later in
still
the
looking
call.
for it too. So we're
It'll come
still
later in the call. It's a reason to stay on.
Oh, okay. All right. Very good.
I think we have Chris joining. Chris, is that you?
Yes, thank you. I'm back from the basement from the tornado warning. So yeah, thanks. I'm back. Happy to help out. What y'all want to talk about?
Well, very happy to have you on.
Please include me. Thank you all.
Well, happy you made it through. Chris, we just started the conversation, so I'm just going to throw the first question I had intended for you. Jack touched on a number of the points, but I just wanted you to kind of set the scene. What new issues arose in 2020, 2022 and 2023 that you think most negatively affected lenders and borrowers?
Oh yeah, thanks. I mean, I think that the biggest one was rising interest rates. Rates rose dramatically. That was I think, from a lending standpoint, the biggest issue for me. Mm-hmm. And others, Jack, you can understand what that is. I mean, rising interest rates, major issue. That complicated underwriting of all types of properties significantly. So I would say, interest rates, for sure, Ben. Mm-hmm. Other issues that were really challenging were inflation of expenses. I really think that was a major issue, along with the interest rates. That's it. That's what I think. Really what happened. During last year, or this year rather. Challenges for the industry. I can tell you firsthand. My parents are in assisted living. They've been there for a while. Their recent recent rate increase for their rents, 8.7%. Pretty challenging, right? So that's what's going on in the industry, I think, right now. Very challenging stuff.
Well, in terms of interest rates, we did get an audience question already, which Chris, Jack, either of you can take this. Don't lenders like to receive a higher interest rate? What do either of you have to say to that? I guess what is the issue with higher interest rates for the lenders?
Yeah, that's a bit of a double-edged sword. I mean, the rate, there's the common consensus on financial news and everything is banks do well in a rising rate environment. Okay, for me, I think it's also a challenge because as the rates go up, it's really, they've gone up dramatically and they've really moved the goalpost in terms of what the performance metric has to be on an actual basis, interest only, in addition to the sensitized benchmark that we all have to live by to satisfy internal underwriting standards. And those numbers are, beyond what we imagined at the beginning of the pandemic. And they're, mid sevens right now. And with any luck, they'll start to moderate some, but there are a lot of deals that were drawn up and, debt and equity got together and thought that they would work at the lower rates when we thought a 6% stress level was very high. So there's been the elongation of the fill-up period, which requires more capital to reach the stabilization. But I think all those factors are out there. And, frankly, our business is not quite measured on just the one metric that rates go up. It, doesn't impact me positively or only negatively based on what I just said. So sorry to be cynical about the question, but I think we're not celebrating over here because of the higher rate environment. I hope that's not too flippant to the audience, but yeah,
Well, I'm not sure how many people were anticipating a really optimistic, glowing call just in the current environment that we're in. So who knows? But Jack, it kind of takes me to my next question, which is why exactly have so many banks pulled back in their lending in recent months?
Well, I think in my limited experience and knowledge of the market, we're still in some transactions today, but we're much more carefully diagnosing everything down to each line item. But we're looking for more stable properties because we really bid off a lot of kind of lease up, unstable, and construction projects. So our balance sheet was in very pristine condition, but as the yield or as the interest rates go up, it has that effect across the portfolio that creates uncertainty. And we see a lot of situations where a construction loan might run out of interest reserve even during construction before they get to the lease up side. So there are all those factors, and I think that was some of the extreme modeling that everyone put together, looking at their portfolios to weigh, just what the risk was going to be, what was going to happen, kind of a wait and see. And I think that's just become accelerated as other items occur. The lease ups take longer. The ability to refinance some of these transactions that were in an extended fill up even before COVID, and they're having a little more of a challenge finding a lender to kind of refresh and give them more runway to reach a stabilization point. I think all of those factors have caused we lenders, at least in my focus, makes us focus internally on our clients because we've got a number of things they need help with, and so we're focused on our book because we jealously protect our credit quality and want to make sure we still have capital for the clients and our relationships, and all want the waters to calm a little bit. It just seems to be taking a little longer to reach that other side, if you will, if that makes any sense.
Well, speaking of credit quality, have regulators made an impact at all just in the last 6 months on banks' willingness to put out new loans?
Well, let's go back to the interest rate question. That was a little more friendly. I think, I don't have any direct knowledge. I do know that, when the extended fill-up periods or the cost the cost of fill-up extends and the cost of interest carry goes up, and the lease-up doesn't reach the velocity we anticipated, or even if it does, it takes a while to increase your rents to make the NOI margin return to a level that gives that debt service coverage everybody looks for. And so those are in place regulations that are just de facto part of the banking world. But I know, we in the bank, at least in my bank, we want to make sure we don't run afoul of any regulations, although I haven't heard of them, parachuting in to do any audits, but I'm sure it's probably going to happen.
Yeah. And Chris, continuing with the banking questions, are you seeing any banks right now that are dealing with current issues with outstanding loans?
Yeah, it's an outstanding item that exists to this point with various commercial banks. It's loan by loan, case by case. We'll see what's happening. The negotiations are really case by case. I mean, it just happens to, it really is based upon what's going on with the loan performance. The actual loan performance of the properties. So that's it's case by case.
Yeah. And among the banks, just kind of speaking a little more generally, who is still lending And what kind of terms can people expect?
Let me take a stab at that first, Chris.
Yeah.
I've
Right,
heard,
I'll
I mean,
let Jack take a stab at that first. Yeah, yeah.
we, admittedly, I said earlier, and we still are looking at transactions, although the aperture of available credit profiles that meet our criteria is very narrow. In other words, we need to really proceed with anything new. It has to be stable, reaching the in-place debt service coverage requirements we have from underwriting guidelines, the proper amount of equity and all the other deal profiles. But we are doing some. We've booked several bridge loans that are bridge to a permanent solution. And so we're looking for those. As I said, I think our appetite for construction is probably satiated for the moment. We have a number of construction loans that are continuing to progress and fund and reach their C of O here in the near future. Although, and that was part of why we, and this is part of your other question, why did we didn't pull back? We just kind of evaluated the growth that we had built in our balance sheet that was based on the intrinsic, funding every month of construction loans, in addition to other pipeline type term loans we had. And so we were able to narrow our focus and become a little more choosy as time passed, but that has continued to clamp down a little bit as the market has shown the effects of the high rates and the cost of wages and things like that, the extended fill up, and the fact that there is good news out there. A lot of borrowers are seeing high rent increases that we've heard have gone very well with their resident populations, because the residents know they have to pay more to get the level of service they expect, and everything's more expensive. But those rate increases have not quite translated into the current financial reporting, because we're still waiting on 331 numbers essentially for most everything right now. So we're mostly risk rating and evaluating based on 1231 and before that. So like I said, banks always look backwards somewhat compared to the entrepreneurs, who always look kind of in place and forward on a run rate basis. So that is that's one of the differences. But anyway, sorry, Ben, was that what you were looking for?
Yeah. Chris, anything to add to that?
Yeah, not really. Jack is on top of it because he looks at all kinds of financing opportunities, new construction and refis. So I think that's a really good, summary of what's going on in the space right now. Honestly, that's what I think.
Yeah.
Chris, we can see a plant or something in your camera. Not sure what we're looking at. Keep going.
There he is. All right. Yeah. Excellent.
Safe and sound.
And the walls are standing. That's a plus.
So Jack, we got an audience question I think is pretty good for you, and it kind of takes us to the next part of the banking conversation, which is talking about construction loans, whether activity in that space is still going. And this audience member asked this: what are the current hurdle rates banks have set on new development projects? Does it differ per segment type, and is a continuum of care, i.e. independent living, assisted living, and memory care, viewed as having a lower beta than traditional assisted living and memory care communities?
Well, I would agree with the last component of that question. But in terms of the metrics, I guess we would look for in construction, which this might answer the question, and if not, then I would ask for a different another chance to try and answer it. But what we're looking for is folks that have been involved in the senior living and long-term care space, or at least senior living and assisted memory care together. We prefer, the owner operator type profile, and someone who's got a track record, a pedigree, if you will, and the normal sponsorship boxes we need to check in terms of the liquidity and or resources. And the hurdles we need to reach are generally with the capital and the reserves that we would build in on the front end, and essentially our down the fairway deal before the market became pretty well frozen, I would say. 65% loan to cost was kind of our strike zone, and certainly lower leverage is better, but it's really, I think it depends on the operator and the market, in addition to those other factors that are just part of the recipe that you have to put together, rather than trying to figure out if the metrics are gonna pencil out. I mean, I think, just to be a devil's advocate, I mean, if you look at a lot of these projects that they really look good back in early 2020, and we thought the pandemic wouldn't be as such a factor, and those projections are not really holding right now. And so it goes back to the operators, their longevity, their interest in kind of the long-term nature of this business. And I think long-term, these are going to be viable communities for the owners of the real estate. And that's why we like the owner operator, because they're more tied to it philosophically and financially. So, I mean, just looking at it like it's more of a real estate transaction, I'm not sure we do that, but I could be all wrong. So,
well, I know that like the loan will have to depend on, or the terms that you get will definitely have to depend on case by case basis. But let's just assume 65% loan to value. Off the top of your head, what kind of range in interest rates could a borrower perhaps expect to see?
Well, I think just getting a loan today would be ideal. So access is going to be the first thing. Price is going to be further down the list, because access in this market is going to be the most important thing they can get. But in terms of, I mean, it's going to be loan to cost, because the loan to value is probably going to be a lot lower than 65% if they build it and it executes as per everyone would expect. But that's not going to happen for 2 to 3 or 4 years from the time you break ground. So, or it could be longer. So, the loan to cost, certainly anything below a 3% interest rate spread, I think would be super. But we're not doing any construction loans right now, so I don't have a benchmark I can give the audience.
I think getting debt in the first place as a good thing is probably a pretty good answer too.
Now, it might change in a few months, and you guys could email me and tell me, wake up, but we're just not seeing it right now.
Mm-hmm. Well, my next question is also for you, Jack, but Chris, if you want to answer first, be my guest. But let's just say I have a property that I acquired in 2019, which a lot of people did. 2019 and 2022 were the busiest M&A years we've ever seen. But let's just say that the property I acquired in 2019 is not ready for a HUD or Fannie Freddie permanent loan, i.e. it's struggling. And you can interpret that how you would, like just under break even, doing worse than that, who knows. But what are my options if I need to refinance? Chris, you want to take that first?
Yeah. Thanks, Ben. Yeah, for sure. Jack and I can tell you firsthand that we've seen a lot of properties that look like this. This is, I think, the number one loan request, in my opinion, for a new loan financing request. Properties that are not leasing up based on their initial portfolio structure, and it really creates issues for banks, right? To finance a property like this. So it's a bridge loan, that's a current bridge loan and our construction loan that needs to go to another bridge loan. So that's a very challenging structure for banks today. And these properties won't qualify for permanent financing, right, through the agency. So Jack, what do you think about that?
Well, yeah, I agree. And Chris is right. I mean, there were lots of these deals we would, look at, and they, the audience is probably pretty familiar with things that, didn't lease up as quick and needed to refresh some reserves and things and kind of get a longer runway to try to get off the ground. But, to your example, Ben, I think that's the challenge. And this is probably the place where the market forces are going to meet and force something to happen with the owners and the lenders. Because, if you've got a building that opened or, you acquired it in 2019 and it's not quite ready for permanent, but it isn't quite ready for, all the bridge financing options, I think there are some hard questions for the owners because the banks really don't have much room based on all the other issues they have to take on a new profile that is still not over one-time coverage and might have a longer term, expectation of getting there, but it hasn't done it yet. So that's another strike against them. So where they're going to have to go is find a way to do some kind of, preferred capital behind the scenes that doesn't stress the property, maybe de-lever it a bit and hopefully ramp it up to reach a refinance that gives them the proceeds they're looking for. But it's all going to go back to the borrower at possibly a lower leverage rate. I mean, I don't know how else you could do it, and then hopefully recapture some of the proceeds at a future point. But I don't know how much flexibility banks, at least speaking for my own, I don't see how much they would have to, offer somewhat of a pro forma turnaround type transaction. Those are real tough because we have some that are, just not quite materializing yet. So it's just it's a dangerous slope to be on at the moment. And so the borrower equity is probably going to be a big part of the solution.
Yeah, it's a tough situation for them to be in, and unfortunately, just because of how active the M&A market was in recent years, there's a lot of people that are facing that question right now, and it brings me to our first poll question for the audience, which is about property owners, and it's a similar question that I just asked you guys that we'll pose to the audience, and I want to get like your personal take on what you would do after this next question. Is the poll up? There we go. So if you are the owner of a seniors housing community that is operating just below break even before debt service and has maturing variable rate debt, would you refinance, sell, or hand the keys to the lender? And I'll get your guys' opinion in just 1 second. Let's leave the poll up for a bit just to get everyone's answers. But Chris, what are some alternative sources for short-term debt if it's not a bank?
Well, first of all, I would say let's try to refinance the transaction. I mean, there's ways to get the refinancing to a different, a positive place, right, with the same lender. So, however, if you had to not do that as a borrower, that's a difficult question. I'm Jack, I don't know what you think, but probably have to go to a debt fund or something, some niche lender that would be able to take place and help you as a borrower.
Yeah, I guess it depends, Chris and Ben, how long has it been on this ramp up? Because where it is in its life cycle will have a lot to do with this, and the demeanor of your lender, all of those items. So if you have something that's just been taken forever, but it's almost there, you know, that might be a situation where you come up with a reserve that, you know, is dedicated to the project and or some other credit enhancement. But that's going to depend by lender, and they probably wouldn't commit. We couldn't commit any of us to any borrower without going through and doing the full underwriting. But I think that might be the quickest way to do it, or somehow, like I said, you know, put in some kind of a equity piece or something that will preserve the financing until you can find a way to, you know, re-access through better performance the debt capital later. But it's, the banks are, you know, very carefully monitoring portfolio quality, and all the stress of high interest has to be erased by some performance at the property level, or you gotta, you know, pay down the loan a little bit. I mean, I can't see selling it. I mean, we've heard of situations where there's an imminent maturity and the idea of a renewal might not be palatable all the way around. On the other hand, you know, who's able to finance anything they want to buy that is not stabilized today? I'm not sure how many folks are out there, unless they're, you know, opportunity buyers with their own cash and without the mandate of a bank or, you know, even a debt fund behind it, because the cost of the loan payment is going to, you know, take a while to cover with a property that isn't quite stable. So that, I don't know. It's an interesting question.
Right.
We've definitely seen those types of buyers.
This could be a
year.
situation for pref equity or mezz debt lender to come in and, you know,
Yeah.
provide their expertise, you know, in that structure to help the property get refinanced. Yep.
Got it. Let's see the results of this poll. All right, there we go. All right.
6% say give the keys to the bank. Boy, that I'm curious to hear how that came up. I mean,
Right.
they must not like
Right.
us bankers, is what I'm thinking. I don't know.
Yeah, of course, this don't call Jack or Chris is what this what it says here. Okay.
Oh my gosh, that's brutal.
All right.
Yeah,
All right.
but
Well,
but I guess as an offshoot of the sell question, Ben, just for the sake of argument, you know, does that mean the owner is willing to entertain a haircut or maybe just a loss of their equity just to kind of get out from under the debt? I mean, that's
yeah, I would think 100% that they would have to see that as a reality, as a fact.
Okay.
Yeah. Let's get our second poll question up. Actually, you guys may find this fun as lenders.
Okay.
All right. So if you're a lender and your borrower is 3 months past due, at this point, should you extend or foreclose? I think in the couple of years after the pandemic, in almost every case, it was extend. But I think understandably, a lot of patience is worn thin. A lot of issues at the community level are turning out to be not exactly pandemic related, but community related, maybe operator related. And so definitely one of the reasons we've been seeing more foreclosures. What would you guys say to this question? Other than we have to take it on a case-by-case basis.
well, naturally, and you're right. Let me throw my 2 cents first. I would say, you know, if they've made it this long, there's got to be a reason we've let them go this long. But I mean, anything over a month is a big problem. A couple of days. I mean, most everybody pays through ACH and things like that. So I would think it'd be pretty adversarial if they're that late. I think there's no other way to go but to try to protect whatever value's there and get your hands on the collateral. But that, I mean, I'm not a workout banker, but to me, that sounds like a situation where we'd want to get control of the asset while it was still an asset, so to speak, at least worth what our debt was.
Chris, what do you think?
Yeah, so 3 months past due, Ben, that's a very tricky point. 3 months past due means that you haven't paid interest and principal. I would just say that, hey, listen, you know, if you're a good relationship player, you would never, first of all, you would never let that loan get to this point. 3 months past due, right, Jack? Don't you think? And
I
then,
agree. Yeah.
yeah, the other point is that, yeah, in our space, let's work it out. Let's see what's going on. Why is this happening? Let's recalibrate the interest rate, covenant to make it current. And honestly, make it current. Let's just get a better covenant package going forward. That's what I would say.
And let's get the results up. Let's see what the audience thinks. All right. Had a rather generous audience.
Of course, yes. Yeah. Right. Us bankers we're user friendly. Yeah, thank you.
Yeah, for the most part. For the most part. But yeah, I think that's a extreme situation. I can't imagine where somebody would be that far behind, and I bet probably not many on the call would either, but it's just my opinion.
Yeah, but what you're gonna get, you're not gonna get a payment default with the borrower. You're gonna see that, well ahead of time. So ideally, that won't happen.
Oh, that's good to hear. All right, well, we can close the poll and let's move on to Fannie and Freddie. Chris, do you want to kind of give us what the current state of lending is at Fannie and Freddie right now?
Yeah, but the general overall summary for the group is they're both committed to the industry. Things are going choppy as far as portfolio performance goes, but Ben, the best thing I could say that they're committed to the industry. If y'all have a new loan that you want to provide to us, bring it in. They're still in business. However, they're being very, very careful about the underwriting of any new project that comes into their purview that we send them. I mean, that's what's going on right now. That's the best thing I can say. Pricing wise, spread wise, pricing generally over the last several months gone down, which is a benefit to the borrowers. But that's a cool thing. Freddie recently announced that they reduced some pricing, but yeah, it's a good space to be in. They're trying to be as flexible as they can on shorter term loans. The space is and good, really.
Well, that's made them more competitive with the banks in recent years, right?
Well, yes. I mean, what's turned out, Ben, to your point, I mean, as an ex-banker, what's turned out to be rather interesting is that the banks have become much more competitive, commercial banks, to Fannie and Freddie on short-term loans, especially. So Fannie and Freddie have taken action to become much more competitive versus the banks. And that's working out pretty nicely. But production is very challenging in the space today for senior housing, in the agency space, just like it is in the banking space, commercial banking space. Jack can verify that, but that's what's happening today.
Yeah.
Any thoughts on the issues that they're currently going through with Sonida and Levin, other potential sticky situations in the next, I guess, in the next year, do you think could come up?
No, I have no comment on that. that's gonna have to work itself out. No comment on that.
Jack, I'll try with you. Any comment?
I don't know where to begin. I'm also pleased that I'm not, up to my neck in those situations. But it can't be positive for this collective group on the phone here. It just is not. It's not going to be a positive thing for all of us together in this industry. But I think I'm hopeful that it's not a sign of more to come. But I don't know all the details, so I have to spare my my opinions on that. I just don't know enough to give a qualified opinion.
Well, my last question on Fannie and Freddie was just whether the current troubles are going to affect their outlook or commitment to the industry in the next couple of years. Chris, I imagine you think absolutely not.
Well, I think thanks. I mean, I think my comment on that would be it affects pricing. However, just recently, Freddie Mac reduced pricing on all kinds of all different executions of senior housing transactions. But it'll affect pricing. Stay tuned. We'll see. We'll see when we submit new financing requests into both agencies and see how they comment back to us on how the deals look in their perspective. But I will say in general, the with both Fannie and Freddie, leverage is becoming an issue, and leverage is a point that every borrower and us as lenders should be looking at. And the leverage percentage, whatever you want to call it, 65, 67, 68, 70%, the lower leverage that you present will be more appreciated, shall I say.
Well, we'll definitely get into leverage in our concluding section. I've got definitely a question about that. I do want to quickly touch on HUD before we get to kind of those bigger questions. And Jack, just kind of, I guess, efficiently, what do borrowers need to know about underwriting a deal with HUD today?
Well, I would say there are, for senior housing and a lien transaction, there are many experienced HUD borrowers who have an understanding and an office, an internal infrastructure of expertise and reporting resources that allow them to, take on the task that is related to a HUD underwriting, all the administrative items that we underwriters would need to compose an application. And those that are new to HUD, it's an education process, to be very vague, but it's an education process that requires your originator and your underwriter to be hand in hand almost every day with them to help them compose and gather the underwriting detail for the process to prepare an application, and then also deal with the timing to get an application put together and respond to all the investigation of underwriting and the, I guess, regulatory information. But that, I guess, the timing and the depth of questions and detail they have to provide is probably the item. But everybody on this call probably already is familiar with that. But the process, if you can help them, the borrower, through it pretty well, it yields a great result for the borrower because they get a long-term fixed rate non-recourse loan that is, at a higher leverage point than almost any other lender can give them. And it still allows them to finance accounts receivable and some HUD debt. Well, all HUD debt is assumable with HUD's approval, but that's also another benefit in most cases. But in my experience, I've seen HUD as a great vehicle for companies that own and operate and that remain privately held through the generations. That it's an awesome capital product for a profile like that. So, but it's going to become more attractive as there are more licensed kind of mixed acuity assisted living opportunities. And, you can't argue with the amortization in the term. It's just that they have to be ready for the reporting and the HUD structure. But, everything has a cost, everything has a benefit. So it's up to us to help educate them.
And just quickly, have like the seasoning requirements or any other kind of rules with obtaining a loan from HUD changed at all after the pandemic?
Well, I'm not a licensed HUD program manager, but what I would say is that their underwriting has become much more focused on items, and they try to normalize expenses, normalize revenue, so that it's more consistent rather than offering before. I mean, anecdotally, there could be HUD underwriters on the call who would vehemently disagree, but I thought there was a little more interest in the current run rate in addition to the historical, but plugging in some current expense and revenue levels. But now it seems that from what I've heard, HUD likes to have that trailing 12 months factually evident to submit an application. But that could change. It could be different from some of the other more high volume HUD lenders. We love HUD, but we certainly don't corner the market like some of the other names out there. So
Yeah. So Ben, thank you, Jack. I mean, I would just supplement for the group that the underwriting guidelines for HUD for senior housing and healthcare loans, skilled nursing properties and stuff like that has to change. There's some modifications that are out for review that are under review by the general population.
Mhm.
So unknown when that will come back to say, hey, these guidelines are different or better or whatever. So that's under review. But as far as HUD rates go, they've increased dramatically, just like Fannie and Freddie rates have. So it's really a borrower underwriter choice to determine what makes sense for the borrower at this point.
I mean, still tough to find better terms anywhere else.
Well, yeah, by better terms, I'm not sure what you mean about that, but as far as the amortization and non-recourse, those are outstanding terms. There's no doubt about that. But now, as far as interest rate goes, the HUD, Fannie, Freddie rates should become more, really equalized versus in the past where HUD rates were more competitive, much more competitive, right, Jack, than Fannie or Freddie rate, for sure.
yeah, the thing with HUD is the rates had been historically lower, but you're locked in a little bit more firmly with a HUD because of the lengthy prepay structure and things like that. But you can always do a rate reduction depending on with your servicer later. But I think Fannie and Freddie have been adaptive too, and they've offered us some floating rate alternatives and sought to be more of a resource to not let the regional banks like us take business that might otherwise fit with Fannie, but the borrowers wanted some flexibility in the prepay. So it just, Fannie and Freddie continue to adapt, which is interesting. Although HUD is programmatic and it's in the federal statutes, and it's going to be what it's going to be. And I think the only changes there are with the underwriters and ultimately the fixed income investors, what they want in terms of rates and prepayments.
Well, let's turn to just a couple of my concluding questions that are just talking about the lending market a little more broadly. And this, my first one, which is probably the big one, is there a problem with leverage in the industry that we're just working through right now?
Yeah, so I'll
I'll punt to Chris.
take that first. Is this industry over leveraged? Generally speaking, I mean, that's a tough question. So I think that the answer is based on property by property level. What's going on is, do we have too much leverage? I would say overall, in my experience doing this for 35 plus years, yeah, there's generally probably too much leverage on properties in senior housing, but you know what? That's okay. It's not okay. It just depends on the property and what the NOI levels are and what the perceived LTC, loan to cost leverage situation is. I would say, Jack, you and I talked about this a lot. We're generally over leveraged on a property basis because today's performance of higher expenses and higher interest rates, it looks like over leveraging on the properties in this industry in general, don't you think?
Yeah, I would just jump in to say that it's my observation would be, does it look over levered? Well, certainly if you're just looking for the next 90 days, definitely maybe, but also long term, I don't think you can deny the demographics and the way the oversupply of livable properties is still, well, it isn't really going to be there. If it is there now, I think there will be a bit of a stabilization of owners and lenders and equity that get back into it, but everybody's trying to figure out what the bottom is and when they can get back in. And we haven't really said it, but I did want to say that anecdotally we've spoken to people looking for institutional equity, and it's just on the sidelines. And this is a big name that probably would be well known on this call, and the fund or the borrower is saying that people are interested in the project, but they're frozen, they're on the sideline, and they don't know when they're going to get back in. And I think that goes to the leverage question. Is it over levered today? Maybe by the models and by the the rates and the underwriting, because the current rates are so much higher than the long-term rate. On the other hand, there's a lot of patient capital in this space, and I think the lenders are trying to be patient, but we have the regulatory gun to our head, to evaluate leverage and all this other stuff. And there are regulators and our loan review teams that haven't seen the problem senior living and long-term care had after PPS in 1998, after the overbuilding in 2000, and after the great financial crisis had all the issues there. But I think it's always rebounded. And so are we too levered now? For the near term, maybe, but I think also too things are going to stabilize and the market will emerge. I'm hopeful, but and it's happened before. It just, when is it going to happen this time, with a confluence of all the issues we've had with the virus, all the free money from the federal government, interest rates going up, wage inflation, all those things. And that, those are items that, are hard to predict. And I think that's why banks and equity is just trying to figure out, what do we do next? And when can we dip our toe back in the water? I guess that's my best guesstimate. Ben, I don't know.
You
Could be
know,
all right.
Ben, to me, listen, I'm a simpleton. So to me, my question is, and answer is, when you look at a property for financing, if you, if the cash flow is available to make debt service coverage, that's fantastic.
Mhm.
And based upon the interest rate that you have to underwrite to, of course. And if it's not, why not? Who who cares what the LTV is? The LTV is secondary. But that's just my
Yeah.
experience in the industry. And the LTV is a very, very problematic issue for banks, Jack, you just described, and for other um, lenders versus the debt service coverage ratio issue. So to
Yeah.
me, debt service coverage, that's where it's at. And if you can't make debt service coverage, it's just like you pay your whole mortgage loan, right? You don't have cash flow to pay your whole mortgage loan, you're in big trouble, right?
Mhm.
Exactly.
So
Yeah,
Yeah.
that does come
it's
down to
no
that.
different for senior housing properties.
Well, yeah, I think that's the biggest challenge, though. I mean, with the rapid ramp up in the rates, that sought after interest coverage, which gives a lot of comfort when things are slow to fill, or other items pop up that cause clouds on the horizon for these things. You generally were able to say, oh, we can cover interest. It may not amortize and cover at the stress rate for a 30-year term loan. On the other hand, it covers interest. Well, now that rates are so much higher, that interest only coverage is very elusive, and that's where we're getting punched in the teeth by the regulatory types, because they'll say, well, it can't even pay its own way as a viable loan. And so that's the big elephant in the room we lenders have, and the borrowers are saying, yeah, but we're still feeding this operating deficits, we're still leasing it up, we're still advertising, we're still committed. And so it's unfortunate, because it's very difficult, but I think the vast majority of owners and operators are very committed to the outcome that they see further out on the horizon. It's just, how do we get through this dark tunnel we're in at the moment?
Yeah.
Yeah.
Well, I mean, hopefully this is a short-term issue, and I know that making predictions is a fool's game, but I think we should end the call with, and this one audience question for both of you, which is, when do you see this lending logjam starting to break? Chris, do you want to take it first?
Oh man, yeah, thank you.
Ending with the most difficult.
Yeah, it's a fabulous, great question. As being a lender for over 35 years in this space, I, I really don't, see this logjam ending in the near future. And the way it's going to end is interest rates reduction,
Mhm.
Lenders feeling that the borrowers have honesty and consistency and NOI margins. And, I think that's when it's going to end. I really do. And I really do. Rate reduction is going to be the biggest part of it. I honestly think, Ben. And then NOI, management is really, really a critical part of this whole thing. And they're related together. Yeah, right. So that's what I think. Jack, what do you think? You're
Well,
you're
yeah,
you're
great
smarter than I am.
points. Let's not go that far. I think
We'll poll the audience. Hang on.
we've seen this for many years, and I think, I'm looking for my magic 8 ball, but I don't have it in my office here. But like I said, I think we're going to start to see evidence that we have to see financial statements, not just borrower reports, anecdotally, hey, we just raised rent 10%. Everybody took it without moving out or complaining, whatever the case may be. But we need to see income statement evidence that the rates are going up to help combat part of this rising cost. In addition to, there was a lot of pent up demand after the pandemic, but it's also thrown out of whack some of the lease up schedules because people waited to move in, they moved in and they were more acute. And so they had to move to a different level of care or they didn't survive. So you might get 10 move-ins in, this month, but then you might have 10 move-outs because your population is maybe more frail, maybe put off going into the facility, going into the community. I hate to say the word facility, don't criticize me for that. But, it's any one of a million items that it could be. But I think, when is this going to clear? I would say, realistically, end of second quarter 24, hopefully we'll have some continuity in the markets and maybe lower rates. I mean, next year's an election year. There's all kinds of bad news popping up on the news about the economy right now. I'm hopeful things will start to moderate rate wise. And, with any luck, the dedication our clients have to the space, I think should start to show up in the numbers. And with any luck, we'll still, have some dry powder to, try to grow some more because, it's all of us on the phone have to grow, I'm pretty sure. So there's going to be a need for us to lend and get back into the market. But what are the parameters and terms going to be is a big question. But I think, first and foremost, let's get through the portfolio management. Maybe we'll have a better idea what it looks like at the end of the third quarter this year or sooner. But I think the ice melts mid next year, maybe.
And Jack, just really quickly in the meantime, does T12 get any shorter? Maybe analyzing by quarter instead. That was an audience question.
That's something I've always advocated for. But in terms of the underwriters at our various bank shops, I don't know. I think there's still a lot of skepticism. And so you can go in and say, okay, well, trailing 3 months is pretty good. We should breathe easy. But I've also heard that we need to see longer than just 1 quarter or 3 months. We need to see, 6, maybe longer. I don't know if 12 is quite there, but I think, if you can show evidence of traction, I mean, I'd fight for it all day long with my credit team. But, again, I'm just one voice in the wilderness. So we'll see how that goes.
All right, you guys. Well, we are over time, but I really appreciate both of you staying on for a few extra minutes and for our audience for staying on but for an extra 10 or 12 minutes. I think the conversation clearly could just keep going for the rest of the afternoon, but unfortunately we have to call it time. I think we got a lot of great audience questions, great answers from you guys, and it was a very fun conversation in some very difficult times. I don't know how you guys managed to do that, and with a tornado on top of that. So
yeah, Annie M was
well, this is Ben. Thank you. This is what the weather is this time of year in Chicagoland, and this is our fourth. I think our fourth tornado warning we've had in the last 2 weeks. But I will say this to folks on the call. I lived through this day by day with my parents. If you have parents that are in senior housing that need senior housing care, we've got to find a way to, as a community, to get together with each other and share issues and needs and hope and other whatever scenarios you want to call it. Because I could only tell you, I thought I knew everything about this business until my parents became skilled nursing and assisted living, patients.
Yeah.
And I found out that I actually was a novice. I knew nothing. So cheers to everybody on the call. we should get together and I'll share more experiences like that. Let's hope for the best for everybody.
Yeah. Thanks, Ben. And thanks, audience, for your attention. I hope it was worth your time. And
thank you to New Point, our sponsor today.
yeah, thanks, New Point. We appreciate that. Thanks, Chris.
Yeah. All right. Be well, everybody. See
All
ya.
right. Thanks, you guys.
Thanks much, everyone. Thank you.